still struggle to save, right?
Yeah, it's like this constant internal battle. This pressure flashing others, so to speak.
Match
Totally.
Quando
And
tu
the
usa
source
o
of
acho,
highlights
de teoria do
people who
ano,
achieve lasting financial success,
They
they
aren't
aren't
always
always
the
the
highest.
highest one.
What do they
Quando
have?
é proibido,
They tend to have this knack for genuinely not caring what others think about it.
A kind of indifference to this.
So it becomes clear, doesn't it?
Your ability to save,
it's way more in your control than you might
Because you
think.
can spend less.
if you
If you
desire,
desire
And you
less,
will desire
if you care less about what others think, it boils down to psychology more than spreadsheets, according to this research.
Okay, so that
So
covers
that
the
covers
I can't save. Saving
Saving
is
is
possible, maybe more possible than
people
people
realize by managing desires
and
and
ego.
ego.
right.
Right.
But what
But what about that
about
other
the
group?
ones who
The ones
feel
who
they don't
feel they don't need to save?
They have
They
good
have good
income,
income,
feel secure.
Why save if you don't have a specific goal in mind?
Well,
This is where the sources uncover this
sort of incalculable value, something
something
beyond
beyond just buying.
I'm intrigued.
Here's
Here's
another
another
example.
example.
You
You don't actually need a specific reason.
Really? So
Not saving for a house or for retirement or for a car.
Those are
Those are fine,
obviously good goals. But the emphasis here is that you can and should save just for the sake of saving.
just building a buffer.
Yeah.
And the back savings sort of listen.
They're
They're
profound,
profound,
but
but often
often
missed.
Right.
because
Because we usually focus on the tangible things money buys, right? The house, the car,
the
the
vacation.
vacation.
But
But
the
the intangible
intangible
returns,
they're
hard
hard
to see, hard to quantify, so they get overlooked.
And yet
These
these intangible benefits.
benefits.
They could be far more valuable. They can contribute much more to your actual happiness than a specific material purchase.
So what are these intangible benefits then?
Savings without a specific goal, it just gives you options, flexibility, the ability to wait for the right moment,
The power to say no, maybe?
yes, and the chance to pounce when a real opportunity comes around. Crucially, it buys you time to think, time to change course if you want to.
Changing course on your own terms. That sounds valuable.
It is,
Yeah.
as the sources put it, really powerful. Every dollar you save is like reclaiming a piece of your future time that someone else might have controlled. You're giving the control back to yourself.
That flexibility, that control over your own time, that's the unseen return on investment.
Exactly. That's the core idea.
So this raises a really interesting question the material brings up. What's the actual return on just having cash in the bank? Cash that lets you maybe switch careers or retire a bit early or just sleep better at night without constant money worries.
What's the ROI on a piece of money?
The sources basically say it's incalculable.
Incalculable, meaning what exactly?
Well, two things really. One, it's so incredibly valuable, it's so important, we can't really put a number on it. But also, literally, you cannot calculate it like an interest rate.
Because it's not a financial percentage.
Precisely. And things we can't easily measure, we tend to overlook or undervalue.
That makes sense. And this flexibility, this control, it becomes even more valuable in today's world.
Also, in what way?
Well, think about how connected it is. Hyper-competitive, globalized. If you don't have control over your time, you're often stuck taking whatever life throws at you, good or bad.
Yeah.
Bad luck, limited options.
You're reacting.
Right. But if you have flexibility, because you save, you have this amazing luxury, the luxury of time.
Yeah.
You can wait for the really good opportunities, the no-brainer, to come to you.
Whether that's in your job or with investments.
Both. This ability just to wait for the right moment, the right fit, it's a massive hidden return on savings. You really can't overstate it.
And it's a competitive advantage too. It's one that's probably getting rarer.
Think of that, maybe a century ago. Your main competition was probably local, right? People in your town and region. Today, if your job involves working with your brain, teaching, marketing, coding, analysis, whatever, your competition isn't just local.
It's global. Millions, maybe billions of people.
Exactly. So the question becomes, how do I possibly stand out in that crowd?
And just saying I'm smart isn't really enough anymore, is it?
Not even close. There are, maybe 600 people who get perfect SAT scores every single year. Thousands more who are nearly perfect. In this global, often winner-take-all environment, those smart people are competing directly with you. Intelligence alone isn't the edge it used to be.
It's becoming table stakes almost.
You've hit on something really crucial there. In a world where pure intelligence is hyper-competitive, Wait for the truly good opportunities. In your career, in your investments.
You have time to adapt.
Exactly. You've got the breathing room to learn new skills when you need to without that feeling of desperation or panic. You feel less pressure to just chase what everyone else is chasing.
You can find your own path, maybe, at your own pace.
Yes, you can find your authentic niche, discover a different routine, maybe a slower pace. You can actually think about life with a different set of possibilities. The ability to do that, when most people are just scrambling, that's a massive differentiator.
That control over your time and your options, it really is becoming one of the most valuable currencies out there. It's more than just money.
For sure. So, okay, wrapping this up, what does all this mean for you listening right now?
Well, we've seen that building wealth, it seems, is way less about chasing some crazy high income or trying to time the market perfectly.
Yeah, it's much, much more about getting a handle on what's genuinely in your power.
Which is,
Your savings rate, your level of frugality,
yeah.
and surprisingly, even your humility, controlling the ego.
We look at the bigger picture here, that unseen return of saving we talked about.
That control over time and options.
It's becoming incredibly valuable in this competitive world. It's a real edge, especially when just being smart isn't enough anymore.
So, it seems really clear from this deep dive. More people absolutely can save money than think they can. And they really should save money.
Not just for the obvious things like a house deposit.
No, but for this incredibly powerful, often invisible benefit. Flexibility, real control over your own life.
That's the ultimate payoff, perhaps.
It really might be.
Yeah.
You know what else people should do, though? Based on some other things we've been looking at.
What's that?
Stop trying to be so perfectly rational with their money all the time. Let me tell you why. Welcome back to the Deep Dive. Today, we're diving into a really interesting idea. It might just change how you look at decisions, especially, when money's involved. We're going to untangle the difference between being rational and being reasonable. Our sources for this deep dive include some truly thought-provoking insights, particularly from a piece that, well, it boldly states you're not a spreadsheet, but actually a screwed-up emotional person. Which is honestly a pretty refreshing take. It gets right to the heart of making choices we can actually stick with.
Yeah, and that's really our mission today. To unpack why aiming for reasonable might actually be, well, a far more effective strategy than just chasing pure cold rationality. We'll explore how this distinction plays out in some really surprising ways. Things like Nobel Prize-winning medical breakthroughs right through to the everyday details of your personal finances. What's really fascinating here is just how much common wisdom gets sort of turned on its head when we look beyond the purely logical.
Okay, let's unpack this. And to really get it, we need to start with a story. It sounds almost unbelievable, actually, a medical history lesson.
Yeah.
Let's talk about Julius Wagner Jauregg. He was a 19th century psychiatrist. Now, this guy, he had this incredible knack for seeing patterns where others just saw chaos. What seemed crazy to some, he saw as bold. His specialty was severe neurosyphilis, which back then was basically a fatal diagnosis, no known cure. But he started noticing something odd. Patients with syphilis sometimes recovered if they also got really high, prolonged fevers from something else, like an unrelated infection. He had this hunch, an idea that had been, floating around for centuries, that fevers somehow help the body fight infection.
Right, so that raised a big question for him. Could fever actually be a treatment? So in the early 1900s, he took this incredibly bold leap. I mean, really bold. He started injecting patients with low-end strains of typhoid, malaria, even smallpox.
Smallpox, wow.
To deliberately trigger strong fevers. Some of them lasted for days.
Days of intense fever. That sounds honestly terrifying. What happened? Did it work?
Well, after some truly tragic trial and error, it actually did work. Wagner Jauregg reported that 6 out of 10 syphilis patients treated with this malariotherapy, as he called it, recovered. Compare that to maybe 3 in 10 who were just left untreated.
Huge difference.
Massive. He won the Nobel Prize in Medicine in 1927 for his endeavor to cure mental disease by inducing a fever. Now, thankfully, penicillin came along and made this treatment obsolete, but he really stands out, one of the only doctors to not only see fever's role, but to actually prescribe it.
Okay, but here's the really mind-blowing part, especially when you think about how you react to fevers today. Like, grab the Tylenol immediately, right? Our sources say modern science actually backs up his seemingly crazy idea. What have we learned since then?
Yeah, it's fascinating. It turns out fevers aren't just, annoying side effects. They genuinely play a crucial role in recovery. We have solid evidence now, just a 1-degree increase in body temperature that can slow the replication rate of some viruses by a factor of 200.
200, wow.
Right. And an NIH paper notes, quote, numerous investigators have identified a better outcome among patients who displayed fever. Even places like Seattle Children's Hospital tell parents, fevers turn on the body's immune system. They help the body fight infection. Normal fevers are good for sick children.
So, okay, millions of years of evolution gave us fever as this like built-in defense. Why is it then that most people, parents, patients, even doctors, drug companies, still treat fever like the enemy, something to be stamped out immediately?
It's a great question, and it really gets to the heart of this rational versus reasonable thing. One study put it pretty bluntly. Treatment of fever is common and likely related to standard dogma rather than evidence-based practice. Howard Markle, who directs the Center for the History of Medicine, he called it fever phobia. He suggested it's more about cultural practices spreading like diseases themselves.
Huh. Culture over biology.
Essentially, yeah. Because the core reason is incredibly simple. Fevers feel awful. They hurt. And people don't want to hurt. So while it might be rational technically to want a fever if you have an infection because of the benefits, it's just not reasonable when you're shivering, miserable, and just want the pain to stop.
You just want relief.
Exactly. A doctor's goal in the real world isn't just curing the disease in a vacuum. It's curing it within what's tolerable for the actual person experiencing it. Offer someone a pill to stop the misery. That's the reasonable choice for most people.
That's such a clear example. This fever phobia really highlights that tension. It makes you wonder, where else does this conflict pop up, this rational versus reasonable? And our sources really dig into this, especially when it comes to, well, money.
Exactly. That's the big connection. This whole philosophy aiming for reasonable instead of strictly rational is something our sources argue more people should think about with their finances. Academic finance often gets obsessed with finding the mathematically perfect investment strategy, the optimal one on paper.
Right, the spreadsheet answer.
The spreadsheet answer, precisely. But in the real world, people don't just want optimal. They want strategies they can actually live with, stick with for the long haul. And that's where reasonable often wins out.
Okay, let's connect this to a big name in finance. Harry Markowitz, Nobel laureate, pioneered modern portfolio theory. Developed all these complex mathematical models back in the 50s. So you'd expect his own money was in some super complex optimized thing, right? What did he actually do?
You'd think so. But no, Markowitz's own portfolio allocation, it was a surprisingly simple 50-50 split, half bonds, half equities.
50-50. After developing portfolio theory. Why?
His reasoning wasn't based on some complex calculation. He actually said he visualized his grief. His grief if the stock market soared and he missed out, or if it crashed and he was all in.
Wow.
His goal, in his words, was to minimize his future regret.
Minimizing regret. That's fascinating. It's an emotion, not a number. What do our sources say about why that approach, even if it's not mathematically perfect, is so powerful for real people?
It's powerful because, well, minimizing future regret is really hard to quantify on a spreadsheet, isn't it? But it's incredibly easy to justify in your own life. A purely rational investor looks only at the numbers, the facts. But a reasonable investor, they factor in the human stuff, the social side, making decisions in a room with colleagues you want to impress, or maybe with a spouse you don't want to disappoint, or even competing against, your brother-in-law, or just your own nagging doubts. Those things are real, even if they aren't on the spreadsheet.
Yeah, those factors matter.
Right. As Jason Zweig put it, reflecting on Markowitz, people are neither rational nor irrational. We are human. We don't like thinking harder than we have to. Our attention is pulled everywhere. Markowitz wasn't being irrational by choosing 50-50. He was just being reasonable.
Okay, here's another example that really hammers this home. In 2008, Yale researchers published this study. They suggested young savers should supercharge their retirement accounts. How? By using 2-to-1 margin. So basically, borrowing $2 for every $1 of your own money to buy stocks. Then gradually reduce that debt as you get older.
And the math on paper looked amazing. The study showed that even if you got totally wiped out, like a 50% market crash would zero you out with 2.1 leverage, you'd still be better off long term. As long as, and this is the key part, you just pick yourself up, dusted yourself off, and started saving that same leveraged account the very next day.
The next day, after losing everything.
Exactly. The expected retirement wealth was calculated to be 90% higher this way. Purely rational, mathematically sound.
Okay, but my gut is screaming, no way. Is that reasonable? Could anyone actually do that?
You nailed it. The answer is it's almost absurdly unreasonable. Think about it. Can you imagine any normal person watching their entire retirement savings evaporate overnight and then just calmly saying, okay, time to start leveraging up again tomorrow? Absolutely not. They'd quit. They'd find a different strategy. They'd probably sue whoever told them to do it.
Right.
So the strategy might promise 90% higher expected wealth on paper, but it's, maybe 100% less reasonable for an actual human being. And this highlights something really crucial. There's actually a rational reason to prefer choices that look irrational on the surface, especially when it comes to commitment. Because few things matter more in finance than just sticking with your strategy, especially when it's going through a rough patch.
That stick-to-wetitiveness, that endurance. Why is that commitment, especially during those lean years, so incredibly vital?
Because history shows the odds are just overwhelmingly stacked in your favor if you can stay in the game long enough. Look at the historical odds for U.S. markets. Making money over one day, basically 50-50, a coin toss, over 1 year, it jumps to about 68%. Over 10 years, about 88%. And over any 20-year period, so far at least, it's been 100%. So anything that helps you stay invested, helps you ride out those inevitable downturns, gives you a quantifiable edge.
Okay, so how does this translate for you, the listener? What does it mean for your choices? Take that common advice. Do what you love.
It sounds a bit like empty fortune cookie wisdom, right? But if you reframe it, if you see it as the thing providing the endurance you need to let those long-term odds work for you, suddenly it becomes maybe the most important part of a financial strategy.
Think about it this way. Say you invest in some company. It looks promising on paper, but you don't really care about it. When things are going well, fine, no problem. But when the market turns, as it always does eventually, and you're losing money on something you have no connection to, it feels like a double burden.
Yeah, it's just pain. Exactly. And the easiest path, the path of least resistance, is just to sell it and move on, cut your losses. But if you're passionate about that company, you love the mission or the product or the team or the science behind it, then the downtimes, which are still going to happen, feel different. They're blunted because you feel like you're part of something meaningful.
It gives you a reason to hang on.
Precisely. That can be the motivation you need to not give up, to stay invested, and let time work its magic.
That human connection providing staying power, it makes sense. Where else do we see this reasonable over rational idea play out in finance?
Oh, there are several other examples where being reasonable, maybe not strictly rational, is perfectly fine. More human, really, like home bias. People tend to invest more in companies from their own country. Rationally, from a pure diversification view, that doesn't make sense.
Right, you should spread it out globally.
You should. But it becomes reasonable when you think of investing as sort of rooting for your home team. It feels comfortable, familiar. Or look at day trading or picking individual stocks. For most people, rationally, it's a losing game. The odds are stacked against you beating the market.
Definitely.
But doing it with a small amount of money, it can be reasonable if it scratches an itch. If it satisfies that urge strongly enough that you leave the rest of your serious diversified money alone. Investor Josh Brown put it perfectly about his own stock picks. He said something like, I'm not doing this because I think I'll generate alpha, outperform the market. I just love stocks. And it's my money. I get to do whatever.
That's pretty reasonable.
Totally reasonable. Even making forecasts. Most economic and market forecasts are, frankly, terrible.
Yeah, notoriously inaccurate.
But making them is still reasonable. It's hardwired into us. It's really difficult to wake up every day and truly accept you have no clue what the future holds, even though that's basically true. Now, acting heavily on those forecasts is dangerous. But the act of forecasting itself, it's human nature.
And there's one final anecdote that just perfectly ties this all together. It's about Jack Bogle, the legendary founder of Vanguard, the guy who spent his entire career championing low-cost, passive index investing, fighting against high fees. What's fascinating, maybe even a bit shocking, is that Bogle himself, the man who said high-fee funds violate the humble rules of arithmetic, he actually invested some of his own money in his son's active high-fee hedge fund.
Yeah. And his explanation to the Wall Street Journal, it pretty much sums up this whole deep dive. He just said, we do some things for family reasons. If it's not consistent, well, life isn't always consistent.
Wow. Life isn't always consistent.
Exactly. Even the ultimate champion of rational, low-cost investing understood that sometimes being reasonable, being human comes first.
So wrapping this up, what does this all mean for you? Our deep dive today really shows that true success, whether we're talking health or wealth, often comes not from just rigidly sticking to mathematical perfection,
Right.
but from understanding and, embracing our own human nature.
Being reasonable really means crafting strategies you can actually stick with through thick and thin, because they account for your emotions, your relationships, your tolerance for discomfort, your need for meaning. It's about designing a financial plan, maybe even a life plan that you can actually live with day in and day out.
Because you're not a spreadsheet. You're a person. A wonderfully complex, sometimes irrational, hopefully reasonable person. And acknowledging that emotional reality, that might just be the most important part of making decisions that truly serve you in the long run. So maybe next time you're facing a big decision, health, money, career, whatever, ask yourself, okay, what's the purely rational choice here? And then ask, but what's the most reasonable choice for me right now in my actual life? What's a rational choice you've maybe avoided because it just didn't feel reasonable for you? Something to think about. We hope this deep dive gave you some powerful new insights to chew on. Until next time, keep learning, keep questioning, and stay curious. Welcome to the deep dive. Today, we're really getting into something fascinating. The psychology behind, why we chase wealth, why we want those material things.
And it's based on some really thought-provoking material you shared. And right off the bat, there's this core idea that just jumps out.
The man in the car paradox. That's what they call it, right? It's such a neat way to frame it.
Exactly. And the way they explain it, well, it starts with this story about a valet, someone who spent his days parking the absolute best cars, Ferraris, Lamborghinis,
Rolls Royces, the whole lot. And his dream, like his big ambition, was to own one himself.
Right. Because he thought driving a car like that sends a message.
Yeah, like I'm smart, I'm rich, look at me, I've made it, that kind of thing.
But then comes the twist, the paradox. He had this realization.
Well, what was it?
Well, he realized that when he saw someone driving one of those amazing cars, he almost never actually thought, wow, that driver is cool.
So what did he think?
His thought, almost subconsciously, was more like, wow, if I had that car, then people would think I'm cool. You see the difference.
Okay. So it's not about admiring the person who has the thing.
Not really, no. It immediately becomes a benchmark for your own desire for admiration. It reflects back onto you.
That's a really subtle, but wow, kind of a huge misdirection we fall into, isn't it?
Yeah.
We buy the thing thinking it signals our status.
But other people just see the thing and use it as fuel for their own desire to be admired. They sort of bypass admiring the owner altogether.
So the admiration we think we're buying, it just doesn't land the way we expect.
That's the core of the paradox, yeah.
Flat out.
And it's important to stress this isn't just about fancy cars.
Right. The source has made that clear. It applies to, well, big houses, expensive jewelry, designer clothes.
Any visible status symbol, really.
Yeah.
The suggestion is that these things often fail to deliver the respect and admiration we're actually seeking from others.
It might even just generate envy, which feels very different from respect.
Exactly. It's a whole different emotional response.
So if chasing these symbols for admiration is, well, kind of a flawed strategy, what's the alternative? Where does that leave us?
Well, the material you shared gets quite profound here. It talks about a letter written by the author to his son.
Oh, yeah, I remember that part. It was very direct advice, wasn't it?
Extremely. He basically said, look, you might think you want the expensive car, the fancy watch, the huge house.
But he says you don't. Not really.
What you actually want, the letter goes on, is respect and admiration from other people.
And here's the key part. And you think having expensive stuff will bring it.
It almost never does, that's the kicker. Especially, he adds, from the people you want to respect and admire you.
Wow, that hits hard. So it's not saying don't pursue wealth or don't enjoy nice things.
No, not at all. The source is clear, the author likes nice things too. It's about understanding the real goal.
The real goal being respect and admiration.
Yes. And recognizing that using money purely to buy status symbols is, well, a pretty inefficient way to get genuine respect, especially from people whose opinions truly matter.
So what does work then? What's the path the source suggests?
It shifts the focus entirely, away from possessions, towards character.
Towards how you treat people.
Precisely. The source argues, quite powerfully, I think, that things like humility, kindness, empathy, Those are the things that earn you far more genuine, lasting respect.
Much more than horsepower or square footage ever could. It makes intuitive sense when you put it like that.
Doesn't it? You think about the people you truly admire. Is it usually because of what they own or because of who they are, their character, their actions?
It's almost always the latter, yeah.
Yeah.
Kindness, integrity, empathy. Those resonate much deeper.
So the real takeaway here, the thing maybe for you listening to consider is this.
What if you shifted just some of that energy away from accumulating more stuff?
And towards actively cultivating those virtues, kindness, humility, empathy. How might that change how people see you?
How might that genuinely earn you the respect and admiration you're probably seeking underneath it all? Something to think about.
You know, we often talk about chasing wealth. We picture maybe big bank balances, fancy houses. But what if? What if true wealth is something else entirely? Something you can't quite put on a balance sheet, but feels much more important.
That's exactly where we're headed today, exploring this really powerful idea that maybe the ultimate luxury money buys isn't, a thing at all.
Okay.
It's freedom, specifically having control over your own time, that incredibly precious, non-renewable asset we all have.
So today we're diving deep into the psychology connecting happiness, money, and this idea of personal autonomy. We're pulling insights from our source material, which is excerpts from Psychology, CSB7.pdf.
Yeah, and our mission here is really to boil down the most crucial takeaways from these pages for you, to help understand how money, especially when you look at it through this lens of controlling your time, can actually build towards a genuinely well-lived life. It's kind of a shortcut to being really informed on this connection.
Okay, so let's start right there then. Unpack this core idea. The source, it kicks off with a really striking definition of freedom. It says, the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today.
Mm-hmm.
That really shifts things, doesn't it? It's not just about having cash. It's redefining wealth.
It totally does, because, we usually think wealth equals possessions, right? The bigger house, the faster car. But this flips it.
Right.
It's not about what you have, but the freedom to decide how you use your time, your most valuable resource, really. And the source hammers this home. It says, the ability to do what you want, when you want, with who you want, for as long as you want, is priceless.
Priceless.
Yeah, it is the highest dividend money pays.
Yeah.
That's a powerful statement.
It really is. And, for a long time, figuring out what actually made people happy was, a bit fuzzy for researchers.
Mm-hmm.
Until a psychologist named Angus Campbell started asking different kinds of questions back in the 80s.
Campbell, University of Michigan.
That's him. His 1981 book, The Sense of Well-Being in America, it was a real departure because back then psychology was mostly looking at, problems.
Yeah.
Depression, anxiety, that sort of thing.
Right. Disorders.
But Campbell, he wanted to understand what made people genuinely happy.
Exactly. And what he found was pretty fascinating, actually. First off, people were generally happier than a lot of folks assumed. But the kicker was he couldn't just group the happiest people by the usual things: income, where they lived, education level.
So it wasn't like, rich people are happiest.
Not necessarily. I mean, sure, some were, but plenty of people with high incomes or fancy degrees were, frankly, miserable, and vice versa.
Okay.
So Campbell dug deeper. And his conclusion was really profound. He stated, and this is a quote worth remembering, having a strong sense of controlling one's life is a more dependable predictor of positive feelings of well-being than any of the objective conditions of life we have considered.
Wow. More dependable than income or education.
More dependable than any of the objective conditions. Think about that. It means it's not primarily your external situation, how much money you make, the house you live in, but your internal feeling, that sense of autonomy, of driver's seat of your own life. That's what truly predicts well-being. It's a real game changer in how we think about happiness.
Okay, so if Campbell nailed it down to this sense of control being the key predictor, what does that tell us about money itself? How does money fit into getting that control?
Well, that's the crucial link, isn't it? And our source is very clear on this. Money's greatest intrinsic value, and this is really the core idea, is its power to give you control over your time.
How so?
It lets you build up, maybe slowly, bit by bit, a level of independence, autonomy. And this comes from having unspent assets, as the source calls them. Think savings, investments, just having enough buffer so you're not living paycheck to paycheck, essentially.
Right, having some breathing room.
And exactly. Breathing room gives you power over what you do and when you do it. The source gives some really concrete examples that make this clear.
Okay, like what?
Well, imagine being able to take a few sick days without worrying about losing income. That's huge for some people.
Yeah, definitely.
Or, say you get laid off. Having enough saved means you can wait for a good job, the right fit, instead of just grabbing the first thing that comes along out of desperation.
That's a big one.
Or having maybe 6 months of emergency expenses tucked away. Suddenly, a bad boss isn't quite so terrifying, is it? Because you know you're not trapped, you have options.
Mm-hmm.
It's also the freedom to maybe take a job that pays less but offers more flexibility. Better commute, better hours, things that improve your actual daily life.
Things luxury goods can't really buy.
Precisely. Or dealing with a medical emergency without the added nightmare of financial stress compounding everything. And the ultimate example, perhaps. Retiring when you choose to, not just when you absolutely have to stop working.
That really paints a picture. It makes so much sense. Using your money to buy back your time, to create options. Yeah, that's a lifestyle benefit that, like you said, very few fancy things can actually compete with. And the source shares this really vivid personal story about the trap of time poverty. It's about someone who, all through college, was convinced investment banking was the path. Why? The money, pure and simple.
Ah, the classic lure.
Right. So they land this summer internship, first day. Reality hits hard. The job was, and I'm quoting here, intellectually stimulating, paid well, and made me feel important. Sounds good so far.
Okay, but
But every waking second of my time became a slave to my boss's demands. Every second. There was even the saying in the office, if you don't come to work on Saturday, don't bother coming back on Sunday.
wow. That's intense.
Yeah, it was supposed to be a 4-month internship. They lasted 1 month. Just walked away.
That story is such a perfect illustration of this psychological idea called reactance. Jonah Berger, he's a marketing professor, explains it really well.
Yeah, it's reactive.
Basically, people like to feel like they're in control in the driver's seat. When you try to force them to do something, even something they might have otherwise wanted to do, they feel like their power is being taken away.
So they push back.
Exactly. They feel disempowered, so they say no, or they do something else entirely just to reassert their autonomy. It's that gut reaction against feeling controlled.
That really drives home how vital that feeling of control is. Because, like the source says, doing something you love on a schedule you can't control can feel the same as doing something you hate.
This is such a crucial point.
So this whole idea of using money strategically, not just for stuff, but to buy back your time, to shape a life where you have that control,
Yeah,
it just offers this incredible return, doesn't it?
absolutely.
It reminds me of that Derek Sivers anecdote the source mentions, the entrepreneur. He told a friend he actually got rich way before he sold his company for
Oh, right, when he was young.
Yeah, at 22, he had this day job paying like $20,000 a year, but his living expenses were super low, only about $1,000 a month. He was earning $1,800 a month,
So he had a surplus.
a decent surplus, and he realized, hey, I can cover my costs easily with just a bit of freelance work. He felt totally free. Quit the day job a month later, never had a traditional job again, the big company sale later. He said that was just more money in the bank. The real feeling of freedom, of being rich, happened years earlier when he gained control over his time.
That's a fantastic example of this principle in action.
And this leads us straight into a really striking paradox that the material points out. Think about it. The United States is, by many measures, the richest nation in history. Wealth and income are much higher than, say, the 1950s, even adjusted for inflation.
Right, objectively wealthier.
Yet. There's little evidence that its citizens are, on average, happier today than they were back then. How can that be?
Yeah, the data backs that up pretty starkly. There was a big Gallup poll in 2019, 150,000 people, 140 countries. It found about 45% of Americans said they felt a lot of worry the day before, the global average. 39%.
Worry is higher. What about stress?
Stress, too. 55% of Americans felt a lot of stress. The global average was 35%. So, richer nation, but seemingly more worried and stressed.
So what's the explanation? Why aren't we happier if we're richer?
Well, the source offers a really compelling argument. It suggests that, by and large, we've used that increased wealth to buy, well, bigger and better stuff.
Material thing.
Exactly. The median American home, for instance. It went from about 983 square feet in 1950 to over 2,400 square feet by 2018.
Wow, more than doubled.
Yeah. More bathrooms than people living there, often faster cars, sharper TVs, you name it. And this is the crucial part, the source argues we've simultaneously given up more control over our time.
Ah, so the gains from suffer canceled out by the loss of time control.
That seems to be the idea. At best, they cancel each other out. Even though median family income adjusted for inflation jumped significantly, like from roughly $29,000 in 1955 to over $62,000 in 2019, we just aren't seeing that translate into higher average happiness levels. So the trade-off hasn't paid off in terms of well-being.
And a huge factor in this loss of time control seems to be how work itself has changed. The source brings up John D. Rockefeller, interestingly.
The oil tycoon, how does he fit in?
Well, his approach to work was apparently quite unique for his time. He wasn't about busy work or physical labor. He was often quiet, observing, just thinking, making decisions. That was his real work.
Strategic thinking.
Right. He even used to recite this little poem. A wise old owl lived in an oak. The more he saw, the less he spoke. The less he spoke, the more he heard. Why aren't we all like that wise old bird? He got that his main output wasn't something he did with his hands, but what happened in his head.
That's fascinating, and definitely different from most work back then. In 1870, think about it, most jobs were manual, like 46% in agriculture, 35% in crafts or manufacturing.
Tangible work.
Very tangible. You could see the output. And crucially, when you clocked out, you clocked out. You left the work there. But today, it's completely flipped.
How so?
Well, now something like 38% of jobs are classified as managers, officials, and proprietors. These are overwhelmingly thought-based jobs. Your primary tool, as the source puts it, is your head, which never leaves you.
So the work follows you home.
Exactly. It feels like it never really ends.
Oh, I definitely feel that. I think a lot of us do. You're thinking about work stuff on your commute, right? Or while you're making dinner, putting the kids to bed. Maybe you wake up at 3 a.m. stressing about a deadline or an email. So even if you're technically on the clock for fewer hours than someone might
put it brilliantly. He said something like, if the operating equipment of the 21st century is a portable device, this means the modern factory is not a place at all. It is the day itself.
Wow. The day itself is the factory.
Think about it. Laptops, smartphones, they free our tools from the office, right? Which sounds great, but it also means we can theoretically be productive anywhere, anytime, which often translates to feeling like we should be productive anywhere, anytime.
So comparing ourselves to earlier generations, our actual control over our time, our mental space, it's arguably lessened.
It seems that way. And if Campbell was right, and that sense of control is paramount for well-being, well, it starts to make sense why we aren't necessarily happier despite being richer. We've traded some control for other things.
This leads us really nicely into some powerful wisdom that comes from looking back over a whole lifetime. The source mentions the work of Carl Pillemer, a gerontologist.
Yes. His book, 30 Lessons for Living. Fascinating stuff.
He interviewed 1,000 elderly Americans, right?
Yeah.
Asking them about the most important lessons they learned over their long lives.
That's right. 1,000 people who'd seen it all. And what's really striking is what they didn't say.
Okay, what did they say?
Well, Pillemer emphasizes this. Not one single person out of that 1,000 said that the key to happiness was working as hard as you possibly can just to make money to buy more things.
Nobody said that.
Nobody. Nor did anyone say it was important to, keep up with the Joneses, be as wealthy as your neighbors, or that having more stuff equals success.
Interesting. What else?
And critically, no one advised choosing your career based purely on how much money you might earn down the line. That wasn't the advice they gave for a fulfilling life.
So what did they value, looking back?
It was much more about human connection and time. Things like quality friendships, being part of something bigger than just themselves, like community or purpose.
Yeah.
And spending quality, unstructured time with their children.
Time with kids.
Yeah, Pillemer quotes them directly on this. They said things like, your kids don't want your money or what your money buys anywhere near as much as they want you. Specifically, they want you with them. Just your presence, your time.
Wow. That's pretty profound advice, coming from people who have lived through it all.
It really is.
So if you take it from them, from those who've seen the whole picture, controlling your time really is the highest dividend money pays. So wrapping this deep dive up, it feels like we've landed on a really clear central insight, doesn't it? Money's most valuable role might not be acquiring possessions, but actually buying freedom, buying control over your own time.
Yeah, it reframes it as the ultimate lifestyle upgrade, in a way. Not the fancy car, but the ability to choose how you spend your hours.
Which definitely encourages some reflection, I think, for you listening.
Exactly. If you connect this back to the bigger picture of your own life, how might rethinking that relationship between money and time actually change things day to day? Or even your long-term happiness? It's worth considering.
And maybe one final thought to leave you with, building on that idea of
the highest dividend money pays. What about the lowest dividends? As you think about gaining control, maybe also ask yourself, what are you currently spending money on that isn't giving you back time or freedom? What might actually be costing you peace of mind rather than enhancing it? That's definitely something interesting for you to explore on your own.
Welcome to the Deep Dive. Today, we're thinking about something I reckon we all do. You know, setting these big goals for the future. Maybe it's a dream job or a certain lifestyle, financial security. We make these huge plans for who we think we'll be. But here's the thing I've been wondering about. How well do we actually know that future person? The one we're planning for? And what happens when, well, the you of tomorrow isn't really thrilled with the plans the you of today made?
It's a really common challenge, and yeah, it has. This deep dive is based on some fascinating stuff from our source, scihaprotein.pdf. It's actually a chapter from a psychology text looking into how we change over time, often in ways we don't expect. So our mission today is to kind of unpack why we often misjudge what we'll want later and, what that does to our big decisions, especially money decisions.
Yeah.
And maybe find some practical ways to handle this human tendency to keep evolving.
Okay, yeah, let's dive in. There's a really powerful story in the source material we should start with. It talks about a friend of the author's who decided, as a teenager, he had to become a doctor against pretty huge odds. Apparently, he wasn't, a natural academic whiz for it, but just incredibly hardworking, probably the hardest worker the author knew. And even though everyone thought, no way, he just pushed and pushed.
And he did it, a decade older than his peers, but he became a doctor. You'd think, okay, that's the dream achieved, right? I mean, starting from basically nothing, fighting his way through med school, getting into this really noble profession, sounds like the perfect ending. But here's the kicker. A few years back, the author bumps into him, asks how he's doing, and the friend just cuts him off. Flat out says, awful career, man. Awful career. And apparently he went on about it for 10 minutes, said the stress, the hours, they just ground him down. He ended up disappointed, really, as he was once determined. It just shows how different imagining a goal is from actually living it day in, day out, with all the real life pressures.
Wow. Yeah, that really hits home. To put in all that effort and then regret it so deeply. What does that say about how we picture the future versus, the lived reality? Is it just bad imagination, or is it something more fundamental about us?
That's a great question, and it connects to so many things, right? Like childhood dreams. Think about the 5-year-old wanting to drive a tractor. The source puts it perfectly. Few jobs look better to a young boy whose idea of a good job starts and ends with room, beep, beep, big tractor, here I come. But then, obviously, they grow up.
Exactly. Driving a tractor maybe isn't the lifelong dream after all. So maybe, as a teenager, the dream becomes being a lawyer. Okay, this is it, law school, set for life. But then they get there and the hours are brutal. They barely see their family, so they pivot. Maybe a lower paying job, but more flexibility. Then they realize childcare costs eat up most of that smaller paycheck. So maybe being a stay-at-home parent is the answer. This feels right. And then suddenly they're 70, looking back, and realize staying home meant they aren't really prepared for retirement. It's this whole winding path.
It is. And so many of us are on a similar kind of path, even if the details differ. And what's really interesting is how these stories tie into a basic psychological finding. People are just not very good at forecasting who they'll be in the future. And there's a data for this. It's not just stories. The Federal Reserve, for example, found only about 27% of college grads end up in a job related to their major.
About 27%. Wow.
Yeah. And get this, 29% of stay-at-home parents actually have a college degree. It suggests, life goals change way beyond what you thought at 18. That 18-year-old picking a major just can't imagine how different their priorities might be as, say, a new parent in their 30s.
So it's more than just tastes changing. It's a fundamental gap in understanding what that future reality will actually feel like. Is there a psychological reason for that blindness?
Yeah, there is. This brings us to Harvard psychologist Daniel Gilbert. He talks about something called the end of history illusion.
Yeah.
It's this really strong feeling we tend to have that our personal evolution is basically just finished. Like, okay, this is me now. This is the always meant to be, and this is who I'll be forever. It's an illusion, but it feels very real.
Gilbert himself said it really well, didn't he? Something like, at every stage of our lives, we make decisions that will profoundly influence the lives of the people we're going to become. And then when we become those people, we're not always thrilled with the decisions we made. That's pretty direct. And you see this playing out all the time, like the source points out. Think about young people paying good money to get tattoos removed that, teenagers pay good money to get. Or middle-aged folks rushing to divorce people that young adults rush to marry. And older adults working hard to lose the weight that middle-aged adults worked hard to gain. It's this constant cycle.
It really is compelling when you lay it out like that. And Gilbert's research actually shows this quantitatively. People from 18 right up to 68 consistently underestimate how much they'll change in the next 10 years.
Yeah.
We genuinely seem to believe our personal history just wrapped up.
Huh. Okay, that's a big idea to absorb. It definitely makes you second guess those big long-term plans. So what does this mean for something really concrete, like long-term financial planning? Charlie Munger always said the first rule of compounding that magic of growth over time is you never interrupt it unnecessarily.
Right, that's the core challenge here, isn't it? How can you avoid interrupting a financial plan, which touches your career, your investments, spending, budgeting, everything, when the person you are, what you want out of life, fundamentally shifts? It's incredibly tough. It's part of why people like Ronald Reed, the janitor who died wealthy, or Warren Buffett are such outliers. They managed to essentially do the same thing, stick to the same path for decades. That let compounding go nuts. But for most of us, we change too much. We either don't want to keep doing the same thing, or maybe life just makes it impossible.
And this source mentions those two extremes in lifestyle choices too. On one hand, you have young people living super simply, maybe very low income, but they seem perfectly happy. On the other, you have people working crazy hours, aiming for luxury, and finding satisfaction in that grind. But given this end of history illusion, are there hidden dangers in locking yourself into either of those extremes?
Oh, absolutely. Look, there's no silver bullet here, no easy answer. But the source suggests two really important things to keep front of mind when you're making these big, supposedly long-term decisions. First, try really hard to avoid the extreme ends of financial life planning. So assuming you'll be happy forever living on very little, or committing to endless work for a huge income. Both paths raise the odds you'll regret it later. Why? Because we adapt. That's the thing about the end of history illusion. The initial thrill of having everything, or maybe the simple romance of having very little, it tends to fade. But the downsides, lack of security or lack of time in relationships, those can stick around as lasting regrets, especially if you then feel like you have to, sprint in the opposite direction later to compensate.
So it's kind of like building in some wiggle room, some resilience. The source really pushes moderation as the key to endurance, doesn't it? It talks about a more moderate path, like moderate savings rate, moderate free time, trying not to have more than a moderate commute, making sure you have at least moderate time with family. That kind of balance makes it much more likely you can actually stick with a plan long enough for it to work and hopefully avoid major regrets. It's about sustainability.
Exactly. Balance for the long haul. And the second big point is maybe even simpler, but harder to do.
Right.
We need to accept that changing our minds is okay. It's normal. It's human. Think about how miserable some people are staying in careers only because that's the major they picked when they were 18. I mean, seriously, what are the odds that the job you pick before you can legally drink is still going to be the perfect fit when you're thinking about Social Security? They're pretty low, right? Almost zero.
That makes total sense. It reminds me of that story about Jason Zweig, the Wall Street Journal columnist, when he was working with Daniel Kahneman on Thinking Fast and Slow. Zweig said Kahneman had this incredible knack for just detonating what they'd written. They'd slave over a chapter, get it just right, and then Kahneman would send back a version that was completely different, totally transformed, unrecognizable.
Right. And Zweig asked him basically, how can you just throw away all that work and start over?
Yeah.
And Kahneman said something Zweig never forgot. He said, essentially, sunk costs, anchoring your choices to past efforts you can't get back, are a devil in a world where people change over time.
Mm-hmm.
Holding on to past decisions just because you spent time or money on them makes it way harder to make good choices for the future you.
And that really brings it back to you, the listener. Embracing this idea that goals you made when you were literally a different person might need to be, abandoned without mercy. Rather than keeping them on life support and dragging them along, that could actually be a really smart way to minimize future regret. It frees you up to pivot, doesn't it? To get back to building wealth or just building a life that fits who you are now. So if there's one core takeaway for you today, it's probably this. You're not fixed. You're not a statue. Your wants, your goals, even your personality, they're going to keep evolving all through your life. And as this deep dive shows, the you of the past is often a pretty poor guide to what the you of the future will actually need or desire.
Absolutely. Which is why those two strategies are worth remembering. First, aim for moderation in your plans. It builds endurance, helps you avoid those painful regrets from going to extreme. And second, just accept that change happens. Let go of those sunk costs. Don't let decisions made by a past version of you trap the current you.
And maybe here's a final thought to chew on. The faster you can accept that you will change and be willing to adjust course when needed, well, maybe the sooner you can get back on track building the kind of wealth and the kind of life that truly aligns with who you are right now and also who you're still becoming.
When the dot-com bubble burst back in the early 2000s, it wiped out something like $6.2 trillion in household wealth. Just vanished.
Astounding numbers.
And then, just a few years on, the housing bubble collapsing took out over $8 trillion more.
It's almost hard to comprehend the scale.
It really is.
Yeah.
And it's not just numbers on a page, is it? These aren't just market corrections. They genuinely ruin people's lives.
Absolutely devastating, socially and personally.
So it just brings up these massive questions. Why?
Yeah.
Why does this keep happening again and again? Why can't we seem to, I don't know, learn? Why don't we learn the lesson?
Yeah, that's the million-dollar question, or maybe the trillion-dollar one. The easy answer people grab is just greed. Everyone's greedy.
Right, that's what you always hear.
But it's frankly too simple. We often find this, right? People make choices that, yeah, they regret later, often with bad information, or maybe logic wasn't front and center. But the key thing is, those choices made sense to them in that moment. So just blaming greed makes us miss the real lessons about how people rationalize things that look greedy later on. Bubbles aren't like a clear medical diagnosis.
Oh, simple test result.
Exactly. It's more like the rise and fall of a political movement or something. You know the outcome, but ask 10 people why it happened and you'll get 10 different answers. The causes are never fully agreed on.
That's a really helpful way to think about it. So less of a moral failing, more about rational choices within a specific, maybe flawed context.
Precisely.
Okay, so if simple greed isn't the main culprit, what is this crucial, often overlooked reason we're diving into today? What's our mission here?
Our mission, really, is to unpack the central idea that investors, often quite innocently, take their cues from other investors who are playing a completely different game.
Different games.
Yes. There's this idea in finance, sounds perfectly reasonable on the surface, but it's caused, well, almost incalculable damage. It's the idea that any given asset, a stock, a house, has one single rational price. But that completely ignores the reality that investors have vastly different goals, different needs, and crucially, different time horizons.
That idea. One rational price. And it does sound fundamental, but when you put it like that, yeah, it seems misleading. How do we figure out a right price then? Like, take Google stock, a huge company. How much should you, the listener, pay for Google stock today? What's the right price?
Well, see, that question itself is flawed without more context. The answer totally depends on who you are.
Right.
If your time horizon is, say, 30 years, you're saving for retirement way down the line.
Okay.
Then the smart price involves, a pretty sober analysis of Google's discounted cash flows over decades, estimating future profits in today's terms.
Makes sense. Long-term view, long-term calculation.
But what if you're planning to cash out in maybe 10 years?
Shorter time frame.
Yeah. Then the price you'd pay might hinge more on your analysis of the whole tech industry's potential over that decade. Can Google's management actually execute their plans? Different calculation.
Okay, and what if it's even shorter?
Right.
Like you're looking to sell within a year.
Now you're looking at total different things. Current product sales cycles, maybe. Is a bear market coming? Things that affect the next few months.
Right. Immediate pressures. And then the day trader.
The day trader. For them, the smart price is almost, well, who cares? Is maybe putting it bluntly, but...
Yeah. Blunt, but probably accurate.
They're just trying to skim a profit off tiny movements between now and, lunchtime. That can happen at almost any price level, as long as it moves predictably for a few hours.
So who cares about the 30-year plan?
Exactly. So a price that looks utterly ridiculous, completely insane to the 30-year investor can make perfect sense to the day trader. Because their focus, their goals, their entire game is different.
Different games, different rational prices.
Which leads us to what I think is an iron rule of finance. Money chases returns, wherever it can find them. So if an asset starts showing momentum, consistently moving up, it's actually not crazy for short-term traders to jump in, assuming it'll keep going up. Not forever, obviously, but just for the short time they need it to.
Right.
Momentum attracts short-term traders, and then, like you said, it's off to the races.
Yeah.
Bubbles really form when that momentum, those short-term returns, attracts so much money that the whole makeup of the market shifts. It goes from mostly long-term holders to mostly short-term traders.
Ah, the balance tips.
Right. And it feeds on itself. More traders push up returns, which attracts even more traders. Pretty soon, the people setting the prices, the ones moving the market minute to minute, are the ones with the shortest time horizons.
Okay, I think I'm getting this. It's not that people suddenly become irrational gamblers overnight.
Not necessarily.
It's more that they've rationally shifted to a different game where the old rules like long-term valuation just don't matter for their immediate goal.
Exactly. That's a great way to put it.
So bubbles aren't really about valuations soaring sky high. That's just a symptom.
Right, the symptom.
The underlying cause is time horizon shrinking. More and more short-term players flooding the field.
Precisely.
Let's make this concrete.
Right.
The dot-com bubble in the 90s. People call it irrational optimism.
Common narrative.
But think about Yahoo. Stock in, say, 1999. Valuation looked crazy to anyone thinking long-term. Absolutely nuts.
Through the roof.
But if you were a day trader,
Yeah.
playing that short game, it made perfect sense to pay a high price. You could make your money whether Yahoo was at $50 or $500. Didn't matter, as long as it moved predictably that day.
And it did move. For a long time.
Yeah. And remember the headlines back then. Record trading volume. All the time.
Oh, yeah. Constant churn.
That screams high-frequency buying and selling,
Yeah.
right? Short horizons. People weren't thinking 20 years ahead. The average holding period for a stock in 99 was apparently just 4 months.
4 months. That's barely long-term thinking at all.
And Maggie Mahar, in her book Bull, pointed out how the media focus shifted to quarterly reports in the mid-90s. That just fueled performance chasing. People piled into mutual funds right when they were most expensive.
Chasing last quarter's winner. Classic short-term behavior.
Exactly. It was the era of day trading, short-term options, constant market commentary. Not exactly a long-term investor's game.
And what's truly wild is how this exact same pattern, this dynamic, played out just a few years later. Different assets, same game shift.
The housing bubble.
The housing bubble. Mid-2000s. Paying $700,000 for a basic 2-bedroom house in Florida. It's really hard to justify that if you plan to live there, raise a family for 10, 20 years.
Almost impossible based on local incomes or rents.
Right. But if your plan is to flip that house in a few months, sell it to someone else for even more in a rising market.
Then it makes perfect sense.
Totally rational for that game, and loads of people are playing it. There's data from Adam, the real estate tracker.
Yeah.
It shows house flipping defined as selling more than once in 12 months went up 5 times during the bubble. 5-fold. From about 20,000 flips a quarter in 2000 to over 100,000 a quarter in early 2004.
Wow. A huge surge in short-term players.
Massive. And then, bam, it collapsed right after the bubble burst. Those flippers, they didn't care about price-to-rent ratios or long-term income growth. Completely irrelevant to their game.
Irrelevant.
The only thing that matters was, will the price be higher next month than this month? And for years, the answer was yes.
Until it wasn't.
Until it very suddenly wasn't. So putting it all together, bubble formation isn't really about rational people suddenly becoming irrational long-term investors.
Okay.
It's more about people somewhat rationally shifting their strategy towards short-term trading to capture that momentum, which has been feeding on itself.
Makes sense.
I mean, what do you expect people to do when there's clear momentum creating big, fast profit potential? Sit on their hands.
Not likely. Money chases returns, like you said.
Never. Not how humans work. Profits will be chased. And those short-term traders, they operate in a zone where the normal rules of long-term investing, especially valuation, they just get ignored.
Yeah.
Because they don't apply to the game being played by them.
Okay, so we've got the short-term game creating this momentum, fueling the bubble.
Yeah.
But now, here's where it gets really damaging, right? For everyday people,
This is the collision point.
it's when the long-term investors playing their game start taking cues from the short-term traders playing that other game.
Yes. The signals get crossed. Badly.
Think about Cisco again back in 99. Stock shoots up 300%, hits $60 a share. The company's valued at $600 billion.
Insane.
Objectively insane by any long-term metric.
Right. Few people actually thought it was worth that. The day traders were just riding the wave. Burton Malkiel, the economist, he pointed out that for Cisco to justify that price, its implied growth rate, meant it would have to become bigger than the entire U.S. economy within 20 years.
Which is just
Yeah.
mathematically impossible.
Preposterous.
Utterly preposterous. BUT. If you were a long-term investor back then wanting to buy Cisco, $60 was the price. That was the market price.
That's the only price on the screen.
So maybe you look around, see everyone else buy it, and see the price soaring, and you think, wow, maybe they know something I don't.
The fear of missing out.
Yeah.
FOMO.
Exactly. Maybe you jump in. Maybe you even feel smart about it for a little while. And that's the terrifying part, isn't it? In the moment, it's so easy to see that rising price and think everyone else can't be wrong.
Yeah.
They must see something. How do you fight that urge, that herd instinct?
It's incredibly difficult because what you don't realize is that the traders setting that price at the margin, the ones pushing it to $60,
Yeah.
they didn't care about 20-year growth prospects. They were planning to sell before the closing bell, hoping it would tick up to $60.50.
Just looking for pennies.
Pennies or dollars, but very short term.
Right.
But that $60 price, for you, the long-term holder, it was a ticking time bomb, a disaster waiting to happen.
And the two types of investors, they don't even know the other exists, really.
Rarely. They're just on the same field, running different plays, maybe even running right towards each other without looking.
And bam.
Yeah.
Someone gets hurt in the collision.
Someone gets hurt. And it's fascinating because so many decisions in finance and investing, they really are rooted in watching what other people do. You either copy them or you bet against them. But if you don't know why someone is acting a certain way, buying that stock, flipping that house, you have no idea how long they'll keep doing it, what might make them stop, or if they'll ever learn their lesson. You're flying blind following them.
It's like when you hear a commentator on TV, on CNBC or wherever, saying you should buy this stock.
Right. Generic advice.
You have to remember, they have no idea who you are listening at home. Are you a teenager with pocket money? Are you an elderly widow trying to preserve capital? Are you a hedge fund manager playing some complex strategy?
Vastly different needs and risk tolerances.
Can't we seriously think those three people should all buy the same stock at the same price? That the current market price is magically right for all of them? It's just illogical when you break it down.
It is, but psychologically, it's really hard to accept that other people who seem rational see the world through a totally different lens than you do.
Yeah.
Especially rising prices. Man, rising prices are like a drug. They can seduce even the most disciplined, value-focused investor into becoming a wide-eyed optimist.
Detached from their own strategy.
Totally detached, pulled into someone else's game simply by the allure of the rising price. And this idea, being swayed by people playing a different game, it's not just money, is it?
No, it's a great point.
It can mess up how we think about all sorts of things. Spending habits, career paths. We look at others, we admire what they have.
Sure.
We see the fancy car, the big house, the nice clothes, the great vacations. But what we don't see are their goals, their anxieties, their specific circumstances, or maybe their huge pile of debt.
Right. The hidden context.
It's a huge trap. Have you ever caught yourself doing that? Kind of unconsciously following someone else's script?
Definitely. That point about not knowing why someone acts really hits home. I think about spending. You see someone with a certain lifestyle, maybe a young lawyer, like you mentioned, trying to make partner. They need the expensive suit, the fancy car, the right address, maybe. It's part of their game, their career strategy.
Right. It's an investment for them, potentially.
But then I, maybe working from home, see that lifestyle and think, oh, I should have that too. But I don't need it for my game.
You're just copying the spending, not the potential payoff.
Exactly. Spending the money without getting the career boost he might be getting. We might even like the same things, but we're playing totally different games. It took me years to really internalize that. It leads to disappointment if you're not careful.
It really does. Which brings us to the core takeaway, I think. Few things matter more with money than truly understanding your own time horizon.
Knowing your game.
Knowing your game, and crucially, not being persuaded by the actions and behaviors of people playing different games than you are.
So what does this mean practically for you listening? The biggest thing you can do is actually take the time to identify what game you're playing. It sounds simple, but it's amazing how few people actually sit down and define that.
It really is. There's this sort of implicit assumption that everyone labeled investor is on the same team, playing by the same rules, like they're all on a basketball court together.
Yeah, all aiming for the same hoop.
But once you realize how wrong that is, how diverse the playing fields and goals are, you see how vital it is to just define your game. What are you trying to achieve? For instance, years ago, I actually wrote down my own investing mission statement. Sounds a bit formal, maybe, but it helped.
What did it say?
Something like, I am a passive investor. I'm optimistic about the world's ability to generate real economic growth over the long run, and I'm confident that over the next 30 years, that growth will benefit my investments.
30 years. A very specific time horizon.
Exactly. And that might sound simple, almost quaint,
Powerful.
but incredibly powerful, because once you have that written down, once you know your game, everything else that doesn't align with that mission, it just becomes noise.
Yeah. Like what the market did this week or this year even.
Mostly irrelevant to a 30-year plan.
That pundit yelling on CNBC.
Irrelevant. It gives you this amazing filter to cut through the chaos and stay focused on your objective.
That's a really actionable piece of advice. Define your game. Right. So let's wrap up this deep dive. The big insight today. These destructive financial bubbles. They're not just about greed. That's too easy.
Far too easy.
They're deeply connected to this dangerous, often invisible collision between different people playing different investment games on the very same field, driven by shrinking time horizons and people getting sucked into following cues from players whose goals are completely different from their own.
Well put. It's about that mismatch and the momentum it creates.
And understanding that gives you a powerful lens to see markets, and maybe other things, differently.
Which leads to a final thought to leave you with. If recognizing your own financial game and tuning out the noise from other players is so critical for your financial well-being, what other areas of your life could be significantly improved by doing the same thing? By clearly defining your own objectives, your own game, and consciously avoiding being pulled off course by the actions and expectations of others who are fundamentally playing a different game than you are.
All right, let's start our deep dive today with a bit of a thought experiment. Picture an alien. Totally logical, just observing Earth.
Okay.
Its job is to check out our economy, specifically between 2007 and 2009. And it sees, the physical stuff.
Like what?
Times Square packed with people, office buildings buzzing, factories running, cars on highways, universities, patents being filed.
Yeah.
Even better tech, like everyone suddenly has a smartphone.
Right. So just looking at all that, the tangible things.
Yeah.
What's the logical takeaway for this alien? Comparing 2009 to 2007, you probably think, well, things seem about the same, maybe even a little better with the new phones and all.
Exactly. That's what makes sense if you only see what's visible. But here's the twist. If this alien could suddenly see our numbers, the human data, it'd be completely baffled.
Because the reality was so different.
Totally. U.S. households, $16 trillion poor, unemployment, 10 million more people out of work. The stock market, worth half what it was.
Wow.
And people's own forecasts, their sense of economic potential, just plummeted, absolutely nosedived.
You can just imagine the alien scratching its head or whatever it has, saying, wait a minute. The cities look the same, factories, knowledge, tools, nothing physical changed all of a sudden.
And that question, that disconnect, that's exactly what we're digging into today. What caused this huge shift that our alien observer couldn't see? We're going to explore these unseen forces and how they mess with economies, sure, but also our own personal decisions, especially about money.
Yeah, like why we tend to believe things we want to be true.
Right, and how we build these complete stories in our heads, even when we only have like half the picture. So let's unpack this.
What's really wild here, maybe a bit scary, is that the only thing that really changed between 2007 and 2009 was the story.
The story we told ourselves about the economy.
Stability. Housing prices always go up. Bankers are smart and careful. Markets price risk perfectly.
Reassuring narrative. People felt comfortable.
Absolutely. Then, boom, 2009. That story didn't just get revised, it shattered, completely broke.
And that breaking wasn't just, a change in sentiment. It set off a real-world chain reaction.
And a nasty one. Home prices fall. People can't pay mortgages. They default. Banks take huge losses. Banks get scared, stop lending money to businesses. Businesses can't borrow, so they lay people off.
Less jobs.
Feeds on itself, a vicious cycle.
This idea of narrative damage, it's incredibly powerful when you compare it to, say, physical damage.
Right. It's not like World War II destroying factories or like Japan's demographic shift with fewer workers in the 2000s. It really drives home the point. Stories are maybe the most powerful force in the economy. So let all that physical stuff, our capabilities, run full steam ahead, or they can slam the brakes on.
Which is?
It connects psychology and finance directly. The more you desperately want something to be true, the more likely you are to grab onto any story, even a flimsy one, that tells you the odds are good. It's a human thing.
That makes sense. It's not just about numbers.
No. There's this great example in a documentary, How to Live Forever. They asked a centenarian about her happiest day. She
Wow.
said Armistice Day, end of World War I. Why? Because we knew, she said, there would be no more wars ever again.
Oh, wow. That's poignant.
Yeah. And just 21 years later, World War II starts. Kills 75 million people. That desire for peace was so intense, it created a belief, a story that just wasn't reality.
You really see how desperation fuels belief there. It reminds me of that quote from Ali Hajaji in Yemen.
Yeah, the folk remedy story.
Right. His son was sick. They folk cure with a burning stick. And he told the reporter, when you have no money and your son is sick, you'll believe anything.
Chilling. And it echoes through history, right? Think about medicine before science really kicked in.
Bloodletting, starvation.
Yeah, sovereign cordials, anything that promised hope.
Because a real solution wasn't available or known. So you grab onto whatever story offers relief.
Exactly. And this plays out constantly in finance.
Like with, say, TV investment gurus. People watch them even if their track record is questionable. Why?
Well, think about the potential payoff. Investing feels high stakes. Even if there's only like a tiny 1% chance, some wild prediction could make you rich.
Listening feels almost rational.
In stock, or you're convinced inflation is about to explode, you're invested, not just financially, but mentally, emotionally.
You want your team to win.
You want your tribe, your chosen narrative. Probabilities. We often just default to believing because the possibility of that huge win exists.
It explains a lot of, let's call it financial quackery, like the mutual fund thing.
Oh yeah, the stat is stark. 85% of active funds end in 2018.
And that's not new. It's been like that for ages.
Yet trillions, nearly $5 trillion, are still invested in them. It defies simple logic if you only look at the numbers.
Or look at Bernie Madoff. Hindsight makes the red flag seem obvious, right?
Totally. Returns that never varied, this tiny unknown auditor, all the secrecy.
But he raised billions from smart, sophisticated people. Why?
Because, as the source says, he told a good story and people wanted to believe it. His story perfectly matched their desire for safe, high returns.
So the takeaway here seems to be skepticism.
Yeah.
And maybe planning for things to go wrong.
Yes, true. Your best defense isn't finding more data to confirm it. It's having that healthy skepticism and, crucially, building in room for error.
A buffer.
A big buffer. It's the ultimate shield against getting sucked into appealing fictions. And this isn't just for individuals. Even the pros fall for wishful thinking.
Like the Federal Reserve in late 2000s.
08, 09, between, what was it, 1.6% and 2.8%. That was their range, their room for error.
And the reality.
The economy actually shrank by over 5%, a massive miss.
Why do they get it so wrong sometimes?
Well, think about it. Predicting a full-blown recession is awkward, it makes your job harder, it spooks everyone, it's just a painful truth to face.
So the tendency is to forecast.
Sure, to kind of shy away from staring the really ugly possibilities right in the face.
And that applies to us too, right? Not just the Fed. If I think a recession's coming and sell all my stocks.
Suddenly your whole view of the economy gets skewed. You need the recession to happen to prove you were right.
So every negative news story looks like proof.
Yeah, you start seeing confirmation everywhere, not because it's objectively there, but because you're looking for it. You want your decision to be validated.
Okay, so how do we protect ourselves from this? From falling for stories we want to believe?
It comes back to those key ideas. Room for error, flexibility, and financial independence. They sound simple, but they're vital.
They're your safety net.
Exactly. The bigger the gap between what you wish were true and what actually needs to be true for your plan to work.
It's the first big theme. How much our desires shape our beliefs. What's the next piece of this puzzle?
It's related. The second core idea is this. We still form a complete narrative in our heads to fill in those missing pieces.
In the fabric.
Perfectly put. Our source uses a great analogy. Think about a 1-year-old baby.
Okay. Cute, but clueless about economics.
Exactly. She has zero concept of jobs, bills, mortgages, the Fed. Trying to explain any of it is pointless.
Right.
But is her world dark and confusing to her? No. She's
Mom's cuddles are safe, food tastes good.
Precisely. It's a coherent narrative based on her limited experience, and crucially, she doesn't know what she doesn't know.